Warren Buffett's secret investment strategy. Who hasn't heard of Warren Buffett? One of the wealthiest persons on the planet and a person who routinely ranks high on Forbes' list of the world's billionaires. As of June 2022, his estimated net worth was $110 billion. It is well known that Buffett is both an excellent businessman and a generous philanthropist. He is most likely recognized for being one of the most successful investors in the history of the world. Because of this, it should not come as a surprise that Warren Buffett's investment technique has become legendary in its own right. He is known for adhering to a number of fundamental principles and an investment philosophy that is widely adopted in many parts of the world. The question is then, what are exactly the keys to his success? Using his management principles, Buffett decided whether or not a company's leadership has traditionally paid out dividends to their investors or reinvestment revenues back into the business. Buffett is more in favor of the second scenario, which indicates that a corporation is keen to maximize shareholder value as opposed to selfishly pocketing all of the earnings than the former. Additionally, Buffett places a strong value on honesty and transparency. After all, every business will inevitably make errors at some point. Nevertheless, only those businesses who are honest about their mistakes can earn the trust of their shareholders. Last but not least, Buffett looks for businesses that aren't afraid to innovate in their approach to business, rather than merely imitating the methods of others. As a result, Buffett only puts money into companies that fit his criteria for simplicity of analysis. After all, it is challenging to make accurate projections of a company's success when the operational philosophy of the business is unclear. Due to the fact that most technology investments were new and unproven at the time, Buffett avoided investing in them. This allowed Buffett to escape suffering major losses after the bursting of the dot-com bubble in the early 2000s. When it comes to financial measures, Buffett prioritizes low-levered businesses that have good profit margins. But above all else, he places a high premium on the significance of the economic value added calculation. This is a method that evaluates the company's profitability by excluding the investment that its shareholders have in the business. In other words, EVA represents the net profit after deducting the costs that were incurred in the process of first raising money. At first look, the calculation of the EVA metric may appear to be difficult due to the fact that it may take into account more than 160 adjustments. In actuality, however, only a few adjustments are normally made, and these are contingent both on the particular business in question and the industry in which it competes. The EVA can be conceptually understood to be comparable to Buffett's final two financial concepts. First, he investigates the numbers that he calls the owner's earnings. This is essentially the cash flow that is available to shareholders, which is more formally referred to as the free cash flow to equity ratio, or the FCFE. This statistic is defined by Buffett as the sum of the net income and depreciation, less any cost associated with capital expenditures and working capital. The earnings of the company's owners are one factor that Buffett considers when determining a company's potential to create cash for shareholders. When it comes to this category, Buffett is looking to determine the inherent worth of a certain company. He achieves this by estimating the future owner's earnings and then discounting those projected earnings back to the amounts they would be at today. In addition, Buffett is known to pay a little attention to short-term shifts in the market and instead concentrate on long-term gains. But on extremely rare instances, Buffett will act on short-term fluctuations, particularly if an enticing bargain presents itself in those circumstances. For instance, if a company that has solid fundamentals has a rapid decline in price from $50 per share to $40 per share, Buffett may decide to purchase a few additional shares at a discount. Finally, Buffett is credited with the rising popularity of the term moat, which he defines as anything that offers a company a clear advantage over others and defends it from intrusions from the competition. The concepts that Buffett has established has served as the basis for the value investing philosophy that he has developed. However, putting these ideas into practice can be challenging because there is a need to develop data and there are metrics that need to be calculated. However, investors who are able to properly apply these analytical techniques will be able to replicate Buffett's performance and see their portfolios grow. Yeah, that's all for today's episode. Also, if you liked the video, be sure to click the thumbs up button. And if you're looking for more interesting content, then hit the subscribe button for future updates.